Let's bring in Zachary Hill, head of portfolio management at Horizon Investments. So, Zach, it really does seem, welcome back. It does kind of seem like when we're trying to analyze the market, you can take one of two routes. One is just the blindfold route, just follow the big tech to the promised land, and then literally like 90% of everything else seems like it's in a little bit of a mess right now with the trade-off between growth and inflation. So what do we do?
Yeah, Oliver, great to be with you this afternoon. And, listening to your conversation before, it's hard to argue. Look, the market has been very, very narrow, especially over the last 3 or 4 weeks. And that comes on the back of a little bit of broadening out that we saw kind of to start this quarter. And, the way that we think about it is to have a kind of a reversion trade out of that, mega cap technology into kind of the rest of the market, whether that's, equal weight S&P or small caps. You really need to see both the company fundamentals and the macro environment be supportive of that. And, nothing that we saw or we've seen really over the last couple months has changed our general thesis. And, last time I was on, I said, sorry to tell the same old story, but it really is the same old story. Stick with quality and large cap growth in tech in the U.S. until proven otherwise. And so that's generally speaking how we're thinking about things.
The quality basket is indeed filled with a lot of the big tech stocks, given the financial prowess they've demonstrated. Many of them pulling the trigger on dividends and payouts over the last couple of quarters. These last 2 weeks, though, distinctly saw a lot of valuation upside as well, which is a little bit of a departure from what we saw in the first quarter. There were periods there when NVIDIA stock was going vertical, but the valuation was going sideways because the growth was so incredible. So does that give us some kind of progression towards the more frothy end of this cycle if we see the valuations start really, like Apple, pure valuation move this week?
Yeah, but obviously analysts are updating their expectations as we continue to get new information around their product launches. And so, I do expect that to lag a little bit. It does show up in the valuations first. But broadly speaking, the way that we're thinking about it, until that macro environment changes, and what I mean by that is either we go into a recession, which is absolutely not our base case at all, or we start to get meaningful Fed cuts because inflation comes down, and Chair Powell, really put the kibosh on that this week. Until or unless one of those two things happen on the macro side, or we start to see, degradation on the earnings front for mega cap technology. We're watching continued growth rates. We need to continue to see those growth rates in revenue and EPS beats because, when that kind of process stops of that continuous beat and raise aspects that we've seen so far, really for the last 18 months, that's where, things start to get a little dicey from the fundamental perspective. But, it's going to be a couple weeks, if not longer, until we start to get another round of earnings, on that theme. So we do think there's a little bit of an air pocket here where the macro is going to kind of, be the main driver.
And if the macro is the main driver, then does that get a little bit more negative if the inflation numbers don't have the momentum that Powell wants to see? It did seem like the FOMC had a distinct opportunity to give the market, kind of throw a bone here to the doves, and they chose not to. Even Powell said, look, we saw that CPI. We had an opportunity to revise our dot plot, but we chose not to.
Yeah, we've been doing a lot of slicing and dicing of CPI, not just us, but the entire market at the Fed, over the last couple of years. And generally speaking, that activity has not been terribly useful from a forecasting perspective, mostly because, a lot of it, it's just used cars, or it's just auto insurance, or it's just medical care, or what have you. A lot of that relies on these kind of normative relationships, which haven't been very reliable in the COVID period. I think that's just a function of how extreme this cycle has been. It has not been like a standard recession and recovery type of dynamic. And so, we've been staying away from a lot of those. But, if you look at this CPI print, it was definitely a good one. Core inflation, I think, was the lowest since the fall of 2021. Super core inflation, and I don't like to slice and dice, but that was actually negative, for this month. Again, the last time we saw that was 2021. But our broad view, after getting burned by the kind of the Q4 pivot last year that the Fed did, and then the reacceleration that we saw in inflation in the first quarter, is the summer is basically off the table. The Fed is just going to continue to kind of sit back and wait and kind of and evaluate as the data comes in. And so we actually, from a macro perspective, think that's broadly supportive for risk markets, because what that's going to do is just suppress volatility and interest rates. And volatility and interest rates has been the main driver of risk, for the last few years. And so that does kind of bias us higher, even though we have seen, some really kind of extreme moves and extreme concentration in equity markets over the last 2 weeks.
Very well said. To the point of the summer months, too, the fact that there's no August meeting from the Fed, it seems like that kind of removes some potential liquidity in the timeline, if you will, to frame it that way, because it kind of says, all right, if they can't move next month, which they've said they basically are not going to, then you've got a little bit wider of a gap than normal for an opportunity for them to revise. Do you guys have a strong view on the role of the election, both either proximity to cuts or just kind of market dynamics this year, how that will affect things?
Yeah, I mean, the election's a little bit awkward. The official messaging from the Fed is that it doesn't matter. I believe that mostly, but not 100%. And so, as kind of we're thinking about it, it's really less important of like when the cut happens. I mean, quite frankly, a 25 basis point cut in September is not going to have any economic impact that's going to have any impact on the November elections. So the way that we're thinking about kind of when this Fed easing cycle starts. And I think the important thing is that they're still just talking about an easing cycle, right? We've cut off that part of the distribution where they're talking about hiking interest rates. So the options are keep rates where they are or move them lower. I think that's an important kind of thing to keep in mind as we talk about all this. But, broadly, and you heard from Chair Powell, he doesn't want to just cut once. We had just one cut from the ECB a few weeks ago, and they did that because they forecasted they were going to do that. And now we've seen some upside surprises in wage and inflation data in Europe. Now they're in an awkward position and they don't know what to do next. I don't think the Fed really wants to be in that position. And so we do think they're going to be patient, and they want to deliver not just one cut, but a series of cuts. They were kind of pointing, if we take their SEP as gospel, which is a bit of a dangerous thing to do, but that's a decent baseline for their thinking. It was quarterly cuts, quarterly 25 basis point cuts next year and the year afterwards, until they kind of feel their way to wherever the new neutral rate is. And so, that's how we're broadly thinking about it. The timing of this is less relevant than the fact that we're going to get cuts at some point.
Sure.
And also that, as Powell continues to say, and I think, the reaction function of the Fed over the last 15 years proves out, if the labor market does start to deteriorate meaningfully, they're going to cut quickly to support the growth side of their mandate.
But not looking to do a one and done or have to backtrack. So I really like that point, too, because it seemed like the market was trying to apply a sort of European Bank of Canada approach to the Fed here about a week ago when the dollar was softening up, even as they were cutting. And that didn't work out for the dollar bears this week. So I think you described things very well, Zach. Appreciate the conversation. Really good analysis on the macro stuff.
Absolutely. Great to be with you, Oliver.
Appreciate that.